On April 2nd, 2025, President Donald Trump announced sweeping Liberation Day tariffs, imposing a 10% baseline on all imports and higher rates on specific countries, 54% on China, 46% on Vietnam, and 20% on the EU. The markets didn't take it well. The stock market fell 15% within just a few days, and the dollar was falling despite rising treasury yields, showing that the markets were questioning the dollar's safe haven status for the first time in generations. Eventually, Scott Bessent persuaded Trump to allow a 90-day pause at the 10% level so that negotiations could take place. This pause applied to all countries apart from China, which had had its tariffs raised to 145%, as punishment for the retaliatory tariffs it had put in place. Now, don't get me wrong, tariffs can be useful in certain circumstances, although they generally raise costs for domestic industry and consumers. They can be useful for security purposes, for ensuring that there is a strong domestic armament industry and securing sufficient food and energy supply. They can also be used to protect strategic industries in the early stages of growth. Today, that might be useful for electric cars, green energy, or AI. So yes, if you want to strategically identify a few key industries, then the benefits may justify a few tariffs and the extra costs they bring. However, the recently announced tariffs to be applied on every country, both friend and foe, is an act of self-harm that will be highly damaging for both the US and the global economy. Potentially, it may serve the narrow electoral base of disgruntled voters in the American Rust Belt that it seems to have been designed for. But once they are also hit by the higher costs that tariffs bring, even they will probably be worse off. So why do people get it so wrong when it comes to tariffs? Well, to some extent, it's the terminology that leads to misunderstanding. Firstly, despite being called a tariff on Chinese goods, the tariff is not paid for by China. It is a tax on US companies and consumers. Whilst foreign companies do lose out on sales, the actual revenues are paid for by the US purchaser through tariffs or higher-priced domestic goods. Secondly, the use of the word deficits can be misleading. All this talk of deficits leads people to think the country is leaking money when that is not the case. It's not widely known that there is always a balance of payments where outflowing dollars must always equal inflowing dollars. Economists have to take some of the blame for this, as they used to call imports a leakage when fixed currencies were the norm for global trade. But that is not the case today. To illustrate with an example, let's take a region like the EU with a single currency. Imagine if everybody in one of those countries, let's say Ireland, decided that they cannot live another day without a top-of-the-range BMW. In fact, let's make it 3 or 4 top-of-the-range models. They all decide suddenly to use all of their cash and liquid assets to immediately buy German cars with a blue and white badge. If they did that, then all of the money, or at least an awful lot of it, could flow out of Ireland. Now, this is obviously an unlikely scenario, but it is possible, and it would almost certainly leave the country worse off, assuming nobody really needs lots of fast cars depreciating rapidly on their driveway. However, in contrast, when you have a floating exchange rate, then that scenario becomes impossible. You see, when trade is transacted using 2 different currencies, let's take another example, say the UK and Japan. Then there are in fact 2 trades to international transactions, one in goods or services and one in FX. That means for you to buy Japanese stuff, someone in Japan will have to buy British stuff. You see, the Japanese company has no use for pounds in Japan. They can't spend them, or pay their employees or suppliers. They can't pay electricity bills, and they can't put them in the bank. So while you might have some foreign currency under the mattress or in the bottom of a drawer, this is obviously not safe for companies with large amounts. So in order for a British consumer to buy a Japanese-built car, then either the British buyer or the Japanese supplier will have to take these pounds to the FX market to find someone who is looking for British stuff. Now, this happens behind the scenes to facilitate foreign trade. You don't see it, as it's usually managed by an agent, but it is there and drives the FX markets, which are highly efficient, and trade currency pairs 24 hours a day for about 5.5 days a week. In short, there must always be a balance, which is why it is called the balance of trade. The amount of pounds flowing out must match exactly the amount of pounds flowing in. So what happens if there isn't a balance? What if there are more British people wanting to buy imports? Well, with a floating exchange system, the market will restore the balance almost instantaneously by changing prices. You see, if there are too many British buyers, then there will be an excess supply of pounds onto the market. This would cause the pound to fall and make foreign goods more expensive and British goods cheaper. Balance will be restored when British consumers literally stop buying Lexuses and the Japanese start buying up Jaguars. Great, so by how much will the pound fall in that situation? Well, that depends on a few things. We can't say without more analysis exactly how much it will fall. It might be by a little or it might be by a lot. But what we can say with certainty is that the exchange rate will always adjust until the supply and demand are equal, until the amount of pounds flowing out equals the amount of pounds flowing back. Okay, let's look a little deeper because this balance of trade actually has some bizarre implications. In fact, 90 years ago, a man called Abba Lerner took it to the next level. Abba Lerner was born in 1903 in Chisinau, a city that was then part of the Russian Empire. At the age of 3, his family emigrated to London, seeking better opportunities and escaping the difficult conditions of Eastern Europe. Growing up in England, Lerner pursued his academic interests, which eventually led him to the London School of Economics in 1929. There, he studied under the famous economist Friedrich Hayek, a leading figure of the Austrian School of Economics, who greatly influenced Lerner's understanding of market dynamics and economic theory. And in 1934, Lerner moved to Cambridge, where he was introduced to John Maynard Keynes and his revolutionary new macroeconomics. In 1936, Lerner published his seminal work on the Lerner symmetry theorem in the prestigious economics journal Economica. This theorem asserts that a tariff imposed on imports ultimately functions as a tariff on exports. This was an incredible idea then, and still is today. What he was saying was, reduced imports would cause an equal reduction of exports because the FX market had to balance. This led to the bizarre conclusion that a tariff on your own exports was just as effective as a tariff on foreign imports, if the goal is to reduce imports. Okay, wow, that's quite interesting. But some of you might be getting a little confused. How come I'm talking about a balance of trade when President Trump is complaining continuously about a trade deficit? And why did I use the word stuff earlier when talking about the balance of payments between Britain and Japan? Well, that's because the balance of payments balances all payments across goods, services, and financial assets, while President Trump is only talking about a deficit in goods. So you see, if we start with a balance of payments with X dollars going out and X dollars coming in, you can see that America gets to buy a lot of Chinese goods and in return sells less American goods. But the services it provides instead are higher value and much more profitable than the silicon chips, clothes, and other goods it is buying. So it does quite well out of the deal. For example, Apple can buy iPhone components for a fraction of the cost of an iPhone and a fraction of the IP license revenues that Apple collects. Meaning American tech companies always take a much greater share of the profits in these arrangements than the Chinese manufacturers who compete on price and have wafer-thin margins. And as you can see from the cubes on the screen, with a balance of payments, when you have a balance and then exclude a sector like services, then there must be a deficit elsewhere. It is simply a mathematical requirement. Similarly with financial assets, America has a large financial services industry, and around 70% of global indexes are comprised of US stocks. That means that when foreign investors buy American financial assets, it is a mathematical requirement that there is an offsetting deficit in goods or services. It is a similar situation in the UK, which also has a large financial sector and has, for that reason, also run a trade deficit for decades. These deficits are often portrayed in the media as a negative, a sign of decline, and it is often implied that a deficit means that the country has to borrow to finance its expenditure. But the truth is actually the opposite of that. The deficit actually demonstrates that investors in other countries are investing in the USA and UK because they believe they offer good returns. And this surplus of investment then requires a deficit in goods and services in order for a balance of payments. That is simply a mathematical requirement. Okay, one final point. I also hear, quite frequently, that China has devalued its currency to make its exporters unfairly competitive. It is often suggested that this is why American and Western manufacturing has been destroyed over the past 20 years. Well, that is debatable. With close to 1 million millionaires and 1,000 billionaires in China, there are a lot of wealthy individuals in China trying to get a portion of their wealth out through legal and grey market activity. And that almost certainly helps to keep a lid on appreciation. But with the trade surplus totaling several trillion over the past decade, I have to admit that it does seem likely that the central bank in China is taking some action to prevent the renminbi from rising significantly. If that is the case, then measures by the US, including tariffs, would be understandable. Although it is also arguable that it would probably be wiser for the US to continue to let China sell its goods cheaply. However, if the US does want to target China as a currency manipulator, then the best way to do this would be to cooperate with their allies, especially given that it is absolutely clear that partners such as the EU and UK are not manipulating their currency in any shape or form. Their central banks are simply not stockpiling reserves. So to conclude, what should the US do? First, scrap the broad-based tariffs. They're a self-inflicted wound, raising costs for American businesses and families, hitting the poor the hardest, and dragging down exports along the way. Second, target strategic industries instead. If electric vehicles, semiconductors, or AI are the future, protect them. But be smart about it, and remember, retaliation is inevitable. And third, if you want to push back against currency manipulation, fine. But bring your allies along with you. China might deserve scrutiny, but the UK and EU definitely don't. Don't push your friends into the arms of the enemy. Work with them. However, on a more general note, President Trump should reconsider his view on trade. It isn't war. At its core, trade is about mutual benefit, an exchange where both sides gain. And the international system set up by America has served the USA well. Overturning it would be reckless. There should be a link showing now. To continue watching, just click. I hope you enjoyed this video. If you did, then please like, subscribe, and follow. Thanks for watching.